welcome to the West Business Development Center. My name is Kelly Geiser, and I'm the event coordinator here at West, hosting today's webinar, Accounting and Business Law Essentials. West is a nonprofit funded by the federal SBA, the Small Business Administration Program. We are both a women's business center and small business development center for Mendocino and Lake County. Through federal and state agencies matched with local community contributions, it is your tax dollars that allow us to provide our services to you for free. Our services include one-on-one counseling, webinars, loan package readiness, and advising to small business owners and entrepreneurs at every stage of business development. We also have a pool of expert advisors that cover niche business needs from permitting to HR, e-commerce, and lawyer advice like Ben here. If you'd like to learn more about becoming a West client, please visit our website or give our office a call. Just a quick disclaimer that today's webinar is for informational and educational purposes only. You can read it in more detail on our website. Without further ado, I'm pleased to introduce today's instructor, Ben Martin, who is presenting Accounting and Business Law Essentials.
Hey, everybody. Thank you, Kelly. Let's see here. Let's start with the thing we should make short as possible. I'm Ben. I go by Ben, Benjamin. Any form of Ben will work for me. I've been a business consultant and an attorney for, I'm not doing well getting old, over about 25 years almost. And I've been working at SBDCs pretty much the whole time. And so my bio is basically one of helping small businesses get started. I love doing it. It really turns me on to do it. It's something actually fun. And when you see what it does for everybody, okay, that's the payoff right there. Because when we people do good and you got a business going, etc., it's like everybody wins. Okay, it may not sound like fun, but you'll be paying taxes. Okay, so the government's happy. You'll be employing people. Okay, those workers are happy, and your standard of living is going to go up. So everybody, it's a win-win. And both sides of the political aisle tend to like small business development centers just for that. And as Kelly pointed out, we also have a women business development center too. But I think the most important thing I've got maybe to offer you guys is I'm a small business too. I am the law firm of me, myself, and I. And I am also a business consultant, right? 2 gigs, 1 provider, but basically 2 businesses. So here's our tour for today. Oh, you know what? I want to ask Kelly to actually take a look at a question I want to know. How many people here, where are you on the I know accounting scale, right? If you're CPAs, go away. You guys know way more than I'll ever know, right? But where are you at? Are you beginning? You hate it? Just a couple, if you wouldn't mind letting Kelly know, and she'll let me know.
Let me make a quick poll, or in the chat is great. I'm seeing it in the chat. We're seeing beginners, don't know where to start, pitiful, basic bookkeeping.
Awesome. Awesome. That sounds like exactly what I wrote this for. I am not good at timing stuff. In fact, my accounting class I used to teach, the first final I gave, I thought they were going to be done in like 2 hours and I was going to be able to send them home. It was an 8 hours on Friday accounting class. And I thought for sure they'll be done in 2 hours or so, 3 for someone who's not feeling so comfortable. And they were still working on it to like near the 7th hour. And I was like, as everyone's leaving the final, I'm going, I'm so sorry. It's not as bad as you feel. So I'm going to be trying to adjust the size of this for our time. So please hang in there with me. And that's one reason why I was asking, what do you guys know? So One of the things we'll be going over is liability avoidance. I do that every time because basically that blindsides a lot of businesses. And a lot of things that you do in management will basically turn into liability if it's not done right. We're going to talk about how you own your business, okay, really briefly. And that's like sole proprietorship, LLC, stuff like that. I think we're going to skip taxes, or we're going to put it at the end. So I don't put you guys into a coma or me into a coma. And then we can get into stuff like GAAP and a little crash course in accounting and basically the principles and rules that kind of merge the merger of both business law and accounting. They're really not they're not really separate. So let's get going here. Boom. Now, here's the law part, right? Here's what everybody usually thinks when they hear talking about business law. This is the more sexy stuff at top here, right? So first, there's fraud. And basically, what is fraud? You intentionally pull the wool over somebody's eyes. You fool them, okay? And one that's very important is wire fraud, okay? And this has become super important because we all became super communicators. We're doing, like right now, we're doing what a television network used to only be able to do, right? Not more than like, what, 10 or 15 years ago. This is TV, right? The Kelly station. Embezzlement, stealing from inside of a business, okay? Insider trading, which was kind of part of our discussion. Insider trading is basically like when people invest in the stock market, okay, all the key information is supposed to go out at one time so no one gets an advantage, right? And insider trading is basically, you know something from somebody who's inside the business who's telling you what's about to happen. And it might be good for the company or bad for the company, but there's ways of making profit in stock trades for both, as long as you're ahead of the game. That's a big no-no. Theft by trick. This is kind of like fraud. It's just trickier. No, it's kind of more cuter. It's like people doing things like, well, a theft by trick would be something like at UPS, where I used to work. Some people decided that they were going to steal stuff from the brown cars they were unloading, right? And instead of putting it in their pockets and getting busted by the guard on the way out, they did something different. They got address labels and put them on top of the original address labels. So if they saw like a jewelry store shipment going by, they just took their address label, put it on there, and put it in the system. A trick, okay? Now there's also what? Tax evasion, all right? Tax evasion is huge and very scary. You don't want to get even closely accused to it, let alone something as simple as an audit happening to you. It's all bad news, but there's a saying about tax evasion. That's how they got Capone, right? Biggest gangster back in the 30s. And what did they bust him for? They didn't bust him for murder. They put him in jail in federal prison, tax evasion, right? So not paying your taxes. Those are the criminal things. The more mundane civil stuff is breaching a contract, right? And that's just like it sounds. You didn't do what you were promised to, whether that's delivering goods or paying somebody for those goods, okay? And negligence. Well, negligence is what? Well, basically you owe somebody kind of a duty to do something responsibly with a certain level of care, and you don't do it, okay? So for instance, if you went to a doctor's office in a state-of-the-art university medical center, you would see what? The doctors would be using all the tests. Okay, that's the duty they have to do. But if they do less than all the tests like they should, right? Negligence. Anyway, I bring these things up because we're not going to go into them straight. They're going to be things that, if you keep this in mind, you'll see how some of these things will pop up or how they intersect with accounting, okay, and the law. And so we'll move on here. So first things first, this is one of my duties, okay? 4 major ways to reduce or avoid liability. Being a good manager. What do I mean by that? First of all, you know what you're doing for your business. You know the business of your business. You do business planning, and you're not a jerk, okay? Your employees are okay with what you do as a boss, and so are your customers, okay? That one, those 2 things right there cut a lot off, because a lot of times what a lawsuit is, you know what? You motivated somebody. They felt they were wronged. Then they waited and looked for an opportunity. Okay, boom, lawsuit. You might have yelled at them, okay, but the payback is going to be when they claim they have an injury at work when it wasn't really at work. That's how justice gets done with people who don't think they're going to get justice for being treated well. So being a good manager, better than anything else. Next, insurance. Insurance is great because, in essence, you have someone sharing the risk with you, okay? But insurance has some problems with it also, in that it doesn't cover everything. And it has to have holes in it, right? If it didn't have holes in it and they covered everything, we couldn't afford it and they couldn't afford to give it to us, right? So lots of exceptions. And also the last thing I'll throw out there is your insurance company and you don't have the same interest almost from the start. They might insure you for that car accident, but how they want to handle it and what's good for you become almost instantly different. Contracts. Contracts is also another way. A lot of people don't realize, especially in business-to-business contracts, you could do things to completely eliminate your liability. You can do things completely, just writing and agreeing with the other side, where you don't even see the inside of a courtroom for whatever goes wrong. Okay, and legal structure. Legal structure we'll be talking about a little bit later here. So let's go on here. Business legal structures. Okay, here's what I'm talking about. This is kind of our menu, and that's what lawyers are. We're kind of we're your server at the table, bringing you a menu of choices here. And what I've highlighted here are the basic ones everybody's doing. Sole proprietorships, one person going into business. Partnerships, 2 or more people. Okay, corporations and LLCs. Okay, one thing that's right here is also S corp isn't a type of corporation. Okay, it's a tax deal for corporations, and the tax deal is basically this: for corporations and LLCs to work, an artificial person owns your business for you. Okay, it gets into contracts with everybody else. So when something goes wrong, all they can do is sue the LLC or corporation. Okay, but okay, someone actually said, well, you got this legal person that's owning the business. We should apply an income tax to that, shouldn't we? Right. So sole proprietorship and partnership, basically your business makes money and you get no liability protection. Okay, but it goes straight into your 1040, to your taxes. Okay, personal and your tax, federal income tax. Boom. Corporations and LLCs, okay, well, they got that liability shield because they got that artificial person that owns the business. And so C corps, larger corporations, have two taxes. They pay at the corporate level, okay? For instance, let's take Microsoft. Okay, Microsoft pays what? Corporate tax. Then when the money's given to Bill Gates, boom, personal income tax, 2 bites. S Corp, okay, is basically a deal that smaller businesses can avoid that top tax, right? And LLCs work just like corporations and the same thing, but they are a lot more user-friendly. If you have a choice between going into a corporation and an LLC, it's no contest about which one's going to be better for you, far as usability. Okay, so we're going to go through. I just explained taxation just generally, so we're going to race through this bad boy, and we'll maybe come back to it later. And let's see here. Oh well, I'll mark my spot. So please forgive me as I go through. Here we go. There we go. So let's get into it. From when you start up and onward during the life of your business, there are accounting rules and concepts, and they act like laws, right? And accounting and tax law is really law with this heavy on the numbers, okay? But they are laws, right? So they act like laws to ensure one of the most important issues that pops up in every legal matter. That list I gave you, embezzlement, negligence, tax evasion, okay, all these things, okay, law enforcement and courts use this one thing for all of those cases, all cases. Every court case, the issue of credibility is king, right? Do you believe that story you're getting from one side or another? Okay, that's in everything. And when you lose it, game over, okay? I was looking at documents from the opposing side, and that's what I did all day long, is reading emails and looking through all types of computerized stuff. And all of a sudden, I see this picture with this memo, and the memo says, hey, all these boxes of stuff, and that's what the picture was, boxes and binders and books and all types of paper and stuff. And it said, all this stuff, what do we do with it? Should we throw it out? Okay, well, I zoomed up to it. I zoomed up to it, and it was basically about the lawsuit, right? And when a lawsuit happens, the first thing you know is you can't get rid of anything related to what's going on, right? So the punchline of this is what? Okay, the response to should we throw this out or shred it was, yeah, I don't see why we need it. Okay, that changed that lawsuit big time. Okay, far as what I used to do for a living, that is almost the equivalent of like a fisherman catching a whale with a rod and reel. Favorite story right there. But soon as they destroyed all this stuff, okay, go before a court and say, Your Honor, trust us, our witness is not lying. Okay, so what we got to do when it comes to accounting and business is we're going to fall into the gap. And for those of you who are old enough to know that tagline, you probably have lots of grays like me. The Gap used to have that fall into the gap. I'm sorry, once again. He goes off on a tangent while he's being recorded. It stands for Generally Accepted Accounting Principles, okay? The rules for reporting and bookkeeping for your business, okay? So let's look at some in action during some important times that happen in the life of every business. Okay, so let's take as a great example here, funding your business. If your business ever needs credit, okay, you know that in essence, you're going to be asked for proof of how the business is going to perform or what it's going to do based on how it's performed before. So what are they going to look at? Financial statements, okay? And financial statements that follow certain rules get more credibility, okay? If they believe you and everything else is good news, you get the loan, right? If they don't believe you, they're not going to even see whether you're worthy of the loan. You go to the circular file or the delete button for your application. You lose out. So financial statements and recording transactions for business, okay, as much as possible, you follow GAAP, generally accepted accounting principles. I forgot the name. I shouldn't have forgotten the name of the organization that basically overlooks it. It's either the AICPA or another accounting quasi-governmental association. Anyway, too much technical stuff. Investors look for this standard also, right? So it's not lenders, it's people who are going to be what? Co-owners with you, right? So let's look at how GAAP gets applied, okay? Basically, when it comes to accounting, and we're going super fast through this, guys, okay? You'll be able to read this later on because we'll be sending you a copy, I believe. Okay, the basic accounting formula is this, okay? Stuff you own minus how much you owe for it equals your net worth, right? How much you're worth, okay? That's called the basic accounting formula, okay? And basically it's used to set up what's called a balance sheet. And a balance sheet is kind of a picture in time, looking at these things, these assets, the things you own, okay, like cash or accounts receivable, money that's owed to you, or inventory or fixtures and equipment, okay? And you list them. That's one side, all the things the business has. But you know what, able to get those things, they have two sources, right? Either you, your owner, put it into the business, or you borrowed and put it into the business. So here's the borrowed part we call liability. This is what businesses owe, right? So credit card debt, accounts payable are basically where you give, say, when your customers credit through your business, directly through your business, right? You give them 30 days to pay, okay? Tax liabilities, other money owed to suppliers, sometimes loans, okay? And here's the big one, right? The combination of red and blue here gets you purple. And if you know me, any excuse to use purple, I'm there. So this popped up last night. Owner's equity, or your net worth, okay, is assets, how much you got, okay, minus how much you had to borrow to get some of that stuff. And then part that's left is what you truly own, the value of what you truly own, right? And this is all put on a sheet that lists assets on the left side, liabilities on the right, and owner's equity or net worth on the right. And when you add them up together, they balance. That's why they call them balance sheets, okay? One of the reasons why I got into doing workshops having to do with accounting is this. Years ago, we were asked to help with a problem. A big chunk of money was floating around in the Pasadena area in the form of grants and loans when I was there. And in essence, people were doing things with their financial statements that weren't good. And one of the biggest obvious things was someone would get something and look at the financial statement and say, this doesn't look good. I think this number over here should be higher, right? So the most important thing about a balance sheet is that assets equals liability plus equity. The two sources can only equal the assets. So they got to balance. You were turning in balance sheets that didn't balance. Basically, that was like rejected, rejected. And not even 20 seconds time of looking at that. Probably 5 seconds looking at it, 15 seconds laughing and throwing it away. Okay. So there are 5 types of basic accounts, okay? And assets are invested or bought, and the sources are either the owner or getting it on credit. And liabilities, amount owed to creditors, Ken already went over this, and net worth accounts, okay? Basically detailing how much the owner gets or owners get. You might even have, like, in a balance sheet, a list of, say, if you have 3 owners, you will have how much of the business is theirs in dollar signs, right? So money is earned, and the earnings are called revenue. So I make a sale, what do we call it? The fancy word is a revenue, okay? And when you use up assets, okay, typically that's an expense, right? So you use up some inventory, okay, well, you know what? That's some type of material expense maybe, okay? What you're saying here is you use it up, and this used up part, these expenses, okay, and this earned part, the revenue, okay, go on to something called an income statement, right? And basically all it really is, okay, blue incoming, this is what we got in, yeah, okay, and what you want not to go out, right? How much money you spend on this. And then you take that minus all of those, and boom, you get your net income. This is why they call it the bottom line, okay? One thing about income statements is this, it covers your operations during a period of time, okay? Where balance sheet takes a picture in time, right? So snap, this is how much assets we have on this date. This is how much liabilities we have this date. This is how much the owners own of all of this. Oops. Okay. Well, income statements go from like between the balance sheets, right? If you had a bunch of balance sheets one day after other, it kind of like like one of those old movies where everything's really jerky and it goes like this because there's only so many exposures. What you need is like a smoother picture going through. So basically the accounting system is we take a picture of how we stand, what we own, what we owe, and how much belongs to the owners. We do our operations, and basically we're going to spend and do different things, and that will bring us in money. So we're going to cover that, what happens during the month, and then record another balance sheet at the end. And that's the pattern. Balance sheet, you run our business, balance sheet again, you run our business, balance sheet, you run our business. So it's kind of giving a more smoother transition. Like when you took old time film and actually moved it, you'd see really clear shot, then one showing the actual movement. And that's what this is. This is showing the movement of your business over time. Okay, so we're going to go past this. Just understand, and when you look at this later, this is color coded, okay, of things that you want to know. You can come back to this and use it, especially when you have to deal with someone who's throwing these terms at you, right? Gross profit, cost of goods sold, all these things, very good to know if you're a business person, right? So in other words, what we're doing here is snapshot, business operations, snapshot again, a good video, boom, really in focus, movement, boom, boom, boom. Okay, so with that, I'm going to ask, do we have any questions about financial statements? And if you don't have questions, you're doing a lot better than I did. This was not my first love.
No questions so far, Ben, but I'll keep you posted if there are.
All righty, thank you. Okay, so able for us to actually know that those financial statements are doing the job for us, right? Going to get money loaned, getting people to invest in us, right? There's these principles that are part of GAAP, generally accepted accounting principles, but everyone just throws it in and calls it GAAP, right? So what I'm going to go through here are these GAAP principles and try to explain them some and, I don't know, flesh them out some. Because the thing is, this isn't something that you do, okay, and forget about it. Or this is nothing like what we do with taxes. You know, you get that big clump of paper and you do your best to organize it, but you have an appointment. So with your tax person, so you bring it in there and you let the accountant make all these things happen. It's got to be kind of done from the start to the end. And this is why I wanted to do this. Okay. So here's one of the principles. And they don't go in any particular order, but this one, it'll make sense as we go. Okay. Historical cost. Okay. Whenever we do something, whenever we record something that happens in the business, okay, someone bought something or we charge something for somebody, we're going to do what? We have to come up with a number. Okay, so the historical cost principle means, okay, when it comes down to it, we're going to have a set number based on what we bought something at, that price. That's the number we're going to use. Okay, we're not going to use market value. Okay, because we need to see some type of structure. And okay, if you bought something and then it gets more valuable, that'd be a great thing. But what happens when it loses value? So to make things less hellacious on you, okay, purchase price. Okay, everything done by purchase price, not how valuable it is to you. If it is super valuable and you got a good deal, yes, you're allowed to smile, do the happy dance because you got a deal. But when it comes to putting the numbers, recording how your business is functioning, purchase value. Okay.
Really quick, Ben, we have a couple questions come in.
Sure.
What about a company providing a service versus selling something?
Same thing. When you would actually get a, and this is more towards purchasing, but contract price, lots of time is what's used here. When you get a service from somebody, it's, you record what's in the contract, what you had to pay them, right? And contract price, same as purchase price for a service. We're good.
Great.
Hope I got that right.
I hope so too.
I mean, I answered your question in other words.
Yeah, two more questions. The first one is, what's the one must-have financial record to get started? They have a simple service providing business and mostly for tax preparation purposes.
Oh, guess what? There isn't one. and that's one of the rubs. That's why we actually have to pay accountants, is because I'm talking about two, right? Balance sheet is something you do, okay, the first day you put things together for your business, you're going to list what you have, what you owe, and how much, how valuable that is to you, right? That difference. Okay, but the process through has to be done also, because you need to go and be able to say, like, the reason why on this day, okay, my business was worth X amount, and this date it's worth more. We have to show what happened in between. And that's why you can't get away with one. And also a little bit later, I'm going to mention a couple others that you're going to also go like, huh? Okay. So if we don't use historical costs, people start using what? Right. Whatever you think looks good for them.
Mm-hmm.
Okay.
All right, and last question before we move on. Are balance sheets and income statements publicly filed for corporations and LLCs?
Depending on the size of the corporation. Okay, for instance, if it's publicly traded, oh yeah, big time, big time. They have to file it, and they've got other things that go along with it that make your head spin, right? And some of the stuff, I didn't get into it here too much, but some of the laws that apply to these big businesses, a lot of smaller and middle-sized businesses are starting to obey those laws, okay? Because they're thinking ahead as far as their liability. One of the types of liability I didn't mention is, okay, suing the manager, one of the owners suing another owner who's managing because they did a bad job. Anyway, I hope that answered your question. Revenue recognition, okay? Record revenue when it's earned instead of when it's collected. Huh? What's the difference? Okay, or record revenue when the cash is received. Okay, basically the revenue recognition principle is huge, especially for balance sheets. And so when the money comes in, excuse me, for income statements, when the money comes in, okay, there's one system called the accrual basis. Okay, and what we do is record everything, okay, money coming in and expenses going out, according to when something was earned and when something wasn't. Right? So this is probably a better one right here to go over. So if you're on the cash system, okay, basically somebody buys something from you, when can you put it down as a sale? Cash. Our favorite, right? Smells good even. Okay. So cash, when the money is received for cash basis, you can do that on your taxes, cash basis. And a lot of consultants, okay, small firms like myself and probably some of you people do cash basis accounting, okay? But there's also accrual accounting, okay? And it basically says, oh, okay, not when you actually receive the money, it's when you legally earned it, right? You legally earned it. So there's some big differences here. Think about one situation where you received the cash for doing the business, and maybe you haven't really earned it yet, right? Okay, you count it, you're kind of counting it before it's hatched, so to speak. In the accrual, it's like, no, when you have a legal right, so to speak, have rights to say, I've done what I needed, okay? It's been earned, right? And so in this case, somebody says, no, I'm not giving it to you. Okay. You still have the value. Why? Because you've done it. You did the work, etc. And you got to record that. It's only fair to yourself. So we want to define when we count money coming in and going out. Okay. And what happens if we don't do it? It's madness, right? It's madness. So one of the things you don't want to ever do is mixing up the two, right? Do I say it right enough? Okay, matching principle. Okay, expenses must be matched and recorded with their respective revenues. This sounds almost like the one above, right? Okay. In the period when the expenses were incurred, instead of when they are paid. Okay. Earned, incurred, kind of their opposites, right? So when we kind of owed it. So what are we actually saying here? Okay, we want to see the impact of our management decisions, right? And we want to match those decisions we made with how much money we made. right? So, okay, use expenses to get sales in the month of January, okay? You want to match them up to what they came in. We did all this stuff. This is our result. You don't want the next month's result, right? They don't match, right? So you're using it for feedback. This is extremely important because businesses, when you're the boss, your only feedback is the stuff you put in the system to work for you. And when we don't get that information, not fun. Okay, full disclosure principle. Okay, any knowledge that materially affects a financial statement. Basically, what are we saying here? Investors don't want to get scammed. So investors and lenders don't want any surprises. And that's what we have. We're saying full disclosure. Okay, if this would change the mind of someone who's using our financial statements about whether they do business to us or not, it should be in there one way or the other. Cost benefit. Now, this is on the other side. Okay, that one was talking about, hey, this is a definition of what you definitely would put in and cover. This is kind of like, what can we ignore? And this one I like writing up because I got to put my skip it on the end. Basically, if something's so small and insignificant to the business, would you record it? Okay, let's see here. Oh, damage to pencil lead. Pencil is no longer usable, should fully depreciate. No, you're not going to do that, right? So this is saying don't sweat the really small stuff. But one thing to always keep in mind here is that sometimes you might see small stuff and it's the start of it happening a lot. And recording it back then could be important. So also have to think in terms of, okay, maybe these things that kind of are like each other, maybe be small, but as a group, do they have importance? Right. So you got to kind of use common sense in that one. Okay, so we don't want to waste time on the small stuff because, hey, it's hard enough covering the big stuff. Okay. Now, for those of you who saw Superman 2, I think this is the correct one. One of the bad guys is an accounting professional who happens to notice that the computer system was rounding off half a cent. And what the guy did was basically made a computer program to collect everybody's half cent from their payroll. And of course, it was for a huge corporation. So this guy was raking in like hundreds of thousands of dollars a month, et cetera. Right? So that's a good way of looking at, hey, something can actually be, something small can actually have big, big impacts. The digital age has also made this a little bit hairy for us because it's so inexpensive now, okay, to say it's going to cost us too much money to record something when all you got to do is go boom, boom, right? So something to watch. Conservatism. Always err on the most conservative side possible in any situation. I use this when I talk to you guys about liability issues when we're one-on-one, okay? But for a different reason. This isn't to defend yourself, right? When you get accused of breaking some rule, breaking the law, they're going to say you did something maybe unwise or extreme, right? And they're going to probably say it's important. And they're going to kind of look at what, okay? One of the biggest examples is overestimating money coming in and underestimating the money going out. Okay, you can see what that would do, right? So if you have a decision about how to treat money coming in, you're going to treat so it goes to the small side. So if someone comes up and starts wagging a finger at your book and at your books, you can say, well, you know what? I could have done this other thing, but I did the most conservative thing. And when it comes to expenses, hey, I did the most conservative thing there. When in doubt, I counted it. Okay. It's against my own self-interest to do this, but that's how much we want our books to be accurate. It's a great defense. Objectivity, okay? So basically, this is saying one great thing. You want basic facts to be in your financial statements versus, okay, having financial statements that seem to be really heavy on you kind of selling things, right? So why you do it, you're going to need to prove your numbers aren't biased, right? If there's anything in there that looks like, okay, wow, you kind of inflated this, just like our previous example, right? You kind of inflated your revenues, or you kind of inflated how much, okay, came in that month, or the assets you got. Okay, sometimes you don't have some straightforward purchase price to go off of. Okay, you're going to need to use something outside of yourself, something independent to verify facts, not opinion. Okay, so one of the things you might actually think about in this is, ever have someone tell you a bunch of too good to be true, okay, and they're trying to get you to do something or buy something, and they're telling you just how awesome this is? What do you do? Okay, you went and checked it. Say, when you're doing these books, okay, don't think you're going to be the only one who ever looks at them. Okay, and basically, an income statement is basically what is the pattern used for tax filings. It's basically income statement spread out with all types of other stuff in it, but based on that, you got to start first making your numbers good up front. Okay. Accounting methods, principles, this is probably just like it sounds. You want to be using the same methodologies from one month to the next month. Okay, and this makes so you can actually look at and see, hey, are we doing better? Are we doing worse than, say, last year? You're going to take everything you can and basically kind of freeze it, so that one thing that's really important to you, how much revenue is coming in, you can actually see, okay, well, you know what, all these things were the same. What did we change that made those revenues go up? So it's reducing it down to like result and what we did for the result. Also, the other thing about consistency is this. One of the things you find when you do accounting, if you do it by hand, like when I started, is this, is you're going to make mistakes. Okay. The only thing that really saves you is keep on making the same mistake. Be consistent. If you keep on going back and forth on how you're going to do something, it is hell to repair. But if you keep on doing everything the same way, it's easier to find all the locations that you might have done it. And you can actually go through and do a very easy, or comparatively easy, fix to it all at once. Okay, especially nowadays that we're no longer paper-based. Oh, monetary use stuff. Okay, basically this is saying, because cash is king, and that's what we use in our financial statements, what are we going to do here? We're not going to use or pretend like all cash is the same. Dollars, yen, lira, pesos, they're not the same value because they aren't from the same situations, right? They go up and down. Once upon a time, the yen was a complete joke. Then, boom, okay? Japan got itself together economically, and the yen was the bomb, okay? Also, things like cryptocurrency, or for instance, the ruble, okay? Things where there's big fluctuations, it's no good for putting it into a balance sheet, because you think to yourself, yeah, it's in rubles, but hey, after all those sanctions, what's it worth now? You need to have consistency, okay? And you don't want anything controversial about the currency you use. We use the dollar here, and most of the world uses it too. Time period assumption is just like it sounds. You're going to make your reports on months, quarters, and years. Why? The whole world's doing it. Why should you be different? Business entity concept. This one's huge. I like this one a lot. Business entity concept is also kind of flops over to the business personal split. Okay. And able to tell a business is doing well, we want to make sure that it's just the one business we're looking at. So bear with me. If you have two people in the intensive care ward, okay, and doctor comes in and looks at one patient, and the breathing rate is boom, 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 like 100 times a minute, just breathe like crazy, okay? Then the doctor goes to this other person, and it's just like 10 minutes goes by. Well, if you took those two together and treated them like they were one patient, it would look like normal breathing, right? Really extreme and darn near nothing. Put it together, it looks like a nice normal average. Okay, that's what happens when you put your business and personal together. They start bleeding into each other, and now you don't know how your business is performing because what? There's personal money being mixed in. And the same thing with more than one business. Okay, you might have a business desk. Well, I'm a good example of this. I need to keep separate. Okay, lawyer activity versus business consultant activity. Huge rules, huge differences of what they do. Okay, and I want to know, okay, is this one profitable or is this one profitable or are they both? Okay, if lawyer activity isn't profitable and it's mixed in with my business consulting, I might keep on staying doing the legal stuff when I should have bailed out on it. But it gets hidden because they're both merged together, right? So when in doubt, keep different businesses separated. What's a business? When in doubt, split it out. I just made that one up, by the way. Going concern concept, okay, is also a consistency thing. And what we're looking for here is this, is that you're going to assume that your business is going to be in business the next period. And the reason why you're doing that is because when people don't think their business is going to be existing, say, in a month or so, there's wild changes in behavior and how you would do things. So you want major factors to be comparable, right? And you don't want, oh, we're stopping this month because I think we're not doing well on this. Then, oh, then a month or two, we're stopping because of another reason. All those things show up in your numbers, strangely enough, and in different ways. So what we're trying to say is, you know what, to take out the, whoa, we're just going to assume, unless you're really pretty sure that it's game over for your business, we're going to assume that's how you're going to go. So it takes out the volatility in numbers. Okay, and materiality. Basically, this is the concept of know your audience. Okay, the reason why you're doing this stuff is for managing, but the other one is for those people that have what money you want, right, or want to partner with, etc. You have to make sure that you're looking at what's important to them, looking at your finances. Okay, so when in doubt, remember your audience. Okay, thank you. I'm notorious for going over. And the last, I think this is our last, nope, yeah, our last one, industry trade or practices. So you have a gold mine and you have your uranium mine, okay? They're both mines. Shouldn't we treat them the same? Well, no, not even they're accounting the same, right? Because the gold mine, okay, that's material that people like and they hold on to. They even wear it, right? Whereas the uranium mine is what? Stuff that comes out of the mine, but the mine where it comes from is now poisonous. It's radiation, and how long it lasts, etc. So there's things where you have to look at how long something will last that we're going to change your accounting big time. So in essence, trade practice, different businesses, slightly different rules, but you want to make the changes only in those spots where the differences are really kind of on the extreme side. Last one, financials get a grade. And when you turn in financials, this used to be the older language. You used to call it consolidations. That's something I can do, right? I mean, anybody can do. Consolidations, you put everything together, okay? A review is maybe you've got your bookkeeper working on it and they've set things up according to how a balance sheet and income statement should look like. Qualified means what? It's GAAP. You're following all the rules, except for one or two places where we have to say you didn't do so well. But the gold standard is unqualified. And unqualified means, yes, all the rules, as far as a CPA goes, looking at your stuff, this has got credibility, it was done correctly. So, wow, right on the dot. That's completely accident. I've never even tried and did that once.
On the nose. Couldn't have asked for a better professional on this.
Thank you. Flattery will get you anywhere.
While we take some questions, or if you're thinking about questions, since we are running out of time, really quick, Ben, if we can go to the next slide.
Come on, slide.
Slide.
Come on, slide. Come on, slide.
Oh, that's okay. Never mind.
Oh, you
Just
know,
if you
it's
take a moment
webinar.
to fill out the poll, again, your feedback. Oh, I see it there. If you can fill out the poll, your feedback is very important to us. Again, it helps us bring these webinars to you for free. And today's webinar was brought to you by a California Women's Business Center located here in Mendocino County at the West Center. But if you are not local to Mendocino or Lake County, these are all the locations all over California. But if you are not located in California, next slide, Ben. We are also a small business development center, which can be found all over the nation. So this is a list of all the Northern California sites, but if you go to the SBDC, if you Google SBDC, they have a zip code thing. You can find a center close to you. They all provide the same no cost, confidential, free business advising. So please do check a center out close to you. And next slide. And that's it. So thank you everyone for your time. Thank you for staying a little bit longer. Ben is always such a great instructor. We always wish we had more time with him. Thankfully, he does have a couple more upcoming webinars, so check them out on our website, westcenter.org. And we hope to see you all at another webinar. Thank you, everyone.
Thanks for coming.
Thank you.